You're standing in your kitchen on a Saturday morning. The sun is hitting the counter just right, and you're scrolling through Zillow. Again. It's basically a ritual at this point, right? You see a house 3 blocks over just hit the market, and you start doing that mental math we all do. You think about your current rent. You think about the dead money you're handing to a landlord every month, and you tell yourself that if you could just get that down payment together, you'd finally be investing in your future instead of someone else's. Honestly, it's the most deeply ingrained piece of advice in the American psyche. Stop throwing away rent. We hear it from our parents, our bosses, and every wealth guru with a ring light and a dream. My name is Nick, and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth while others stay stuck in the same financial patterns for decades. I've spent thousands of hours staring at spreadsheets and public financial statements, trying to figure out why the common sense advice we're all given feels so, well, wrong. Because when you actually strip away the emotion, the white picket fence nostalgia and the social pressure, and you run the cold, hard numbers for the year 2026, you discover something that might actually make you a little angry. You discover that for a huge portion of the population, renting isn't throwing money away, it's actually the smartest wealth-building move they'll ever make. Today, I want to pull back the curtain on what I call the homeownership mirage. I'm going to show you the real math that your mortgage broker and your real estate agent won't ever mention. We're going to look at why a renter named Sarah is on track to end up $4 million richer than her neighbor Chris, who did the responsible thing and bought the house next door. We're going to talk about the 5 silent vampires that drain a homeowner's net worth while they aren't looking. Basically, by the end of this conversation, you're going to have a perspective shift that could change the entire trajectory of your financial life. Is owning a house a bad choice? Not necessarily. But is it the best investment you'll ever make? Well, the math has a very different story to tell. The rent is a waste fallacy. We have to start with the big one, the psychological hurdle that keeps people from seeing the truth. The idea is that rent is 100% loss while a mortgage payment is building equity. It sounds so logical on paper, doesn't it? But honestly, this is the financial equivalent of telling someone the earth is flat. When you pay rent, you're paying for a service, shelter. You're paying for the right to live in a space without being responsible for the property taxes, the leaking roof, or the $8,000 HVAC unit that decides to quit on a Tuesday in July. But here's the thing. Homeowners throw away money every single month too. They just give it different names so it doesn't hurt as much. Think about it. When Chris buys that $400,000 house, he's not just paying himself, he's paying property taxes, usually about 1.5% of the home's value every year. On a $400K house, that's $6,000 a year, or $500 a month, gone forever. He's paying homeowner's insurance. He's paying mortgage interest, which at 2026 rates, let's say 6.5%, is absolutely staggering. In the first few years of a mortgage, roughly 80% of Chris's payment is going straight to the bank's profit margin, not his equity. So Chris is throwing away $2,000 a month in interest, taxes, and insurance. But because he owns the dirt, we call him an investor. Meanwhile, Sarah pays $2,200 in rent, and we call her a wasteful renter. Basically, they are both paying for the privilege of living somewhere. The only difference is that Sarah's unrecoverable costs are capped at her rent check, and Chris's unrecoverable costs are just the starting point of his financial journey. The 5 silent vampires of homeownership. To understand why renting is often richer, you have to look at the hidden layers of the transaction. In the wealth logic formula, we don't look at the sticker price, we look at the net outcome after the silent vampires take their cut. Vampire 1. Property taxes. As we mentioned, this is a permanent inflating tax on your wealth. Unlike a stock portfolio, which doesn't charge you a fee just for existing, a house demands a subscription fee to the local government every year. If your house goes up in value, your tax bill goes up too. You're essentially penalized for being successful. Vampire 2, maintenance and the rule of 1%. Most people assume their house will stay in perfect condition forever. It won't. The industry rule is that you'll spend about 1% of the house's value every year just to keep it from falling apart. On that $400K house, that's $4,000 a year. New water heaters, repainting the deck, fixing a cracked driveway. It's a never-ending cycle of leakage that Sarah, the renter, never has to worry about. Vampire 3, mortgage interest. This is the big one. On a 30-year loan, you can end up paying as much in interest as the original price of the house. If Chris borrows $320,000 at 6.5%, he's going to pay back over $400,000 in interest alone. He's not buying a $400K house, he's buying a $400K and interest product from the bank. Vampire 4, insurance and HOA fees. These are pure unrecoverable costs. They add zero to your equity but take a massive bite out of your monthly cash flow. Vampire 5, transaction costs. This is the exit tax. When Chris finally decides to move, he's going to lose about 6% of the house's total value to realtor fees and closing costs. If the house is worth $500K then, he just handed $30,000 to the system just to get his own money out. Honestly, when you add these up, the real math shows that the net return on a primary residence is often only 1 to 2% a year. Sometimes it's even negative. That's the mirage. It looks like wealth because the number is big, but the leaks are everywhere. The story of Sarah and Chris, the $4 million gap. Let's make this concrete with a simulation because I think stories help the math land in a way that spreadsheets can't. Meet Sarah and Chris. Both are 30 years old. Both have $60,000 in the bank. Both earn $90,000 a year. They're basically the same person, just with different operating systems for their money. Chris decides to buy a house. He puts his $60,000 down as a 20% down payment. His mortgage, taxes, and insurance come to about $2,200 a month. He's proud. He's building a legacy. He spends his weekends at Home Depot buying mulch and light fixtures. He's the responsible one. Sarah decides to rent. She finds a similar house for $2,200. But instead of giving her $60,000 to a bank, she puts it into a low-cost S&P 500 index fund. And because she doesn't have to pay for a new roof or property taxes, she has an extra $500, the money Chris is spending on maintenance and repairs, and she invests that too. Now, let's fast forward 30 years. Historically, the average U.S. home appreciates at about 4% per year. So Chris's $300,000 house is now worth about $970,000. He owns it outright. He feels like a millionaire. But Sarah did something different. Historically, the S&P 500 returns about 10% per year. Sarah's $60,000 initial investment plus her $500 monthly contributions has grown in a completely different way. After 30 years, Sarah's portfolio is worth approximately $5.2 million. Let that sink in for a second. Chris has a house worth $970,000. Sarah has a brokerage account worth $5.2 million. They started with the same money. They had the same income. They lived in the same neighborhood. But the real math created a $4 million gap between them. Chris wasn't investing in a house, he was consuming a house, while Sarah was investing in the global economy. Basically, Chris bought a slow engine, real estate appreciation, and Sarah bought a fast engine, the stock market. When you run the numbers through a 30-year compounding window, the difference isn't just a few bucks. It's the difference between a comfortable retirement and generational wealth. The 4% versus 10% battle. Why the spread matters. You might be thinking, wait, Nick, how can the gap be that big? Houses go up in value. And you're right, they do. But they go up at a rate that barely beats inflation. The real math secret that most people miss is the crossover point of compounding. When an asset grows at 4%, it's like a person walking. It's steady, it's fine, But it's slow. When an asset grows at 10%, it's like a person on a bicycle. Over a mile, the difference isn't huge, but over 30 miles, the person on the bike is in another town while the walker is still looking for a snack. But it's actually worse for the homeowner than just a 4% versus 10% spread. Because remember those silent vampires? Chris has to subtract property taxes, 1.5%, maintenance, 1%, and insurance, 0.5% from his 4% growth. His real annual return is effectively 1%. Sarah, on the other hand, is earning 10%. Even if we account for taxes on her gains, let's be conservative and say she pays 15% in capital gains. She's still netting around 8.5%. The spread between Chris's 1% real return and Sarah's 8.5% real return is the most expensive thing Chris will ever own. Honestly, it's a bandwidth tax on his life. He's working 40 hours a week, but his primary asset is only working at 10% of the efficiency of Sarah's asset. It's like trying to win a race while dragging a parachute. The house is the parachute. It provides drag in the form of fees and low returns, while the stock market provides a tailwind in the form of corporate profits and innovation. The forced savings myth. Now, I can hear the objection already. But Nick, if I didn't have a mortgage, I wouldn't save anything. The house forces me to be disciplined. Honestly, this is the most depressing argument in all of financial planning. It's basically saying, I am so bad with money that I need a bank to threaten to take my home away just to make me build a net worth. It's forced savings through the threat of homelessness. And look, I get it. Discipline is hard. Automation is the only thing that actually works for most people. But you don't need a 30-year debt contract to be disciplined. You just need a Kuhn-Keon habit, the Chinese secret of deposit first. If Sarah sets up an automatic transfer of $500 a month to her brokerage account the day after she gets paid, she has the exact same forced savings as Chris, but with none of the unrecoverable costs. She's building wealth in a liquid, high-growth asset instead of a clunky, illiquid house. The idea that we need a mortgage to be responsible is a narrative sold by the banking industry to keep us in 30-year debt cycles. They want you to believe you can't be trusted with your own cash flow so that you'll hand it to them in the form of interest. But the math shows that if you can just handle a simple automatic transfer, the forced savings benefit of a house completely vanishes. Optionality, the hidden currency of renters. There's a factor that never shows up on a spreadsheet, but it might be the most valuable thing you can own: optionality. When Chris buys that house, he is locked in. He has a bandwidth tax on his career. If a job opens up in another city that pays $20,000 more a year, Chris has to think about selling his house, paying the 6% transaction fee, and the stress of moving. He might stay at his current job just because moving is too expensive. Sarah doesn't have that problem. She has walking money on. When her landlord raises the rent too much, she moves. If she gets a better job offer, she moves. If the neighborhood starts to decline, she moves. She is the passenger in her financial life, not the engine that has to stay in the garage. This flexibility has a real dollar value. According to Wealth Logic research, people who job hop every 2 to 3 years earn roughly 30 to 40% more over their lifetime than people who stay put. Homeownership is a mobility killer. By trying to save money on rent, Chris might be costing himself hundreds of thousands of dollars in lifetime earnings because he's not pivot ready. Renting gives you the freedom to chase the highest income lever. In 2026, where the economy moves at the speed of light, being unlocked is a competitive advantage that a house simply can't compete with. The renovation trap, investing in new countertops. We also have to talk about the renovation mirage. Chris decides his kitchen is outdated. He tells himself that spending $50,000 on a remodel is an investment because it will increase the home's value. Honestly, the data is brutal on this. The average kitchen remodel only recoups about 60 to 70% of what you spend. If Chris spends $50,000, he's adding maybe $35,000 to the price of the house. He just invested himself into a $15,000 loss. Sarah, the renter, looks at her kitchen and says, it's fine. She takes that $50,000 and puts it into an index fund. In 10 years, Sarah's $50,000 has become $130,000. Chris's kitchen, well, it's now 10 years old and outdated again. We've been trained to view every dollar we spend on our home as building equity, but most of it is just lifestyle consumption dressed up in a wealth costume. Renovate because you want a nicer kitchen. That's fine. Just don't lie to yourself and call it an investment. It's a luxury, and luxuries are fine, but they're not the math guru skip-over path to $4 million. The liquidity problem, the locked wealth crisis. Let's imagine it's 10 years down the road. Both Sarah and Chris face a $40,000 emergency. Maybe it's medical, maybe it's a family crisis. Life happens. Sarah pulls up her brokerage app. She sells $40,000 worth of shares. The money is in her bank account in 3 business days. She owes some capital gains tax, sure, but the crisis is handled. She has liquid wealth. Chris has $250,000 in home equity, but he can't spend equity. He has to borrow against it. He applies for a HELOC, home equity line of credit. But since he just lost his job, the reason he needs the $40,000, the bank might not approve him. He's sitting on $250,000, but he's house poor. He has locked wealth. He might end up paying 9% interest on a loan just to access his own money. That's the deception. Homeowners feel rich because of their net worth, but they're often one sequence of returns risk event away from a catastrophe. Renting allows you to keep your wealth in a high availability state. You're not just richer on paper, you're richer in real life because you can actually use the money when you need it. When should you actually buy? Now look, I'm not saying you should never buy a house. I'm just saying you should do it with your eyes open to the real math. Buying a house is a lifestyle decision, not a wealth-building strategy. You should buy a house if you want stability. You don't want to worry about a landlord selling the property. You want to customize. You want to paint the walls neon pink or knock out a wall without asking permission. You have kids in a specific school district. The community value matters more than the portfolio value. Or you've already maxed out your other fast engines. You've captured your 401k match, maxed your Roth IRA, and have a solid brokerage account. If you're buying for those reasons, great, enjoy your home. But if you're buying because you think it's the only way to get rich, you're making a $4 million mistake. You're buying a clunky, illiquid asset that will underperform a basic index fund every single time when you account for the silent vampires. Reclaiming your financial engine. So, what's the protocol? How do you actually replicate Sarah's success? It's simpler than the gurus make it sound. It's about the real math of the crossover. Step 1. Accept that rent is a service fee, not dead money. Step 2. Take the down payment you were saving and put it into a compounding engine, a low-cost S&P 500 index fund. Step 3. Calculate your unrecoverable cost gap. If a mortgage on a house would cost you $3,000 a month and rent costs you $2,200, take that $800 difference and automate it into your brokerage account. When you do this, you're not throwing money away. You're actually buying back your time. You're building a portfolio that outworks you while you sleep. By year 15, the crossover happens and your investments start earning more per year than you're contributing. At that point, you're the passenger in a wealth machine that Chris, with his leaking roof and his property tax bills, will never be able to build. We've covered a lot of ground today, and I know some of this feels counterintuitive. It's hard to ignore a lifetime of people telling you that renting is for suckers. But at the end of the day, the math doesn't have an ego. The math doesn't care about the American dream or what your coworkers think about your apartment. The math only cares about compounding, unrecoverable costs, and the 10% versus 4% spread.
When you look at Sarah and Chris, the lesson isn't that one is smarter or better. The lesson is that the operating system you choose for your money determines the destination. Chris chose a system that optimizes for looking rich today. The big house, the nice lawn, the status symbol. Sarah chose a system that optimizes for being rich tomorrow. The liquid portfolio, the optionality, the $4 million advantage. Honestly, the most important thing you can do this week is to sit down with a notebook and define what enough looks like for you. If enough is a stable home for your family and you don't mind the $4 million trade-off, that is a valid choice. But if enough is freedom, the ability to retire at 50, to travel, to never worry about a boss again, then you need to stop chasing the homeownership mirage. You are the engine of your financial life. Don't let that engine get bogged down in property taxes and mortgage interest before it has a chance to take off. Renting isn't a failure. For many of you watching this, it's the launch pad that will make the rest of your life possible. The math always wins. If this conversation changed how you think about that Zillow notification, do me a favor. Hit that subscribe button and share this with someone who is currently stressing about their down payment. We break down the real math that gurus skip over every single week. Stop staring at the picket fence and start building the runway.